the debt side of real estate and lending against the asset class at the moment. We've all heard a lot of commentary from allocators and LPs wanting to shift their focus to distressed assets, and I just sort of wonder if perhaps that is the best approach for everybody, of course. But from your viewpoint, Gareth, at this point in time, I know you have experienced a number of these situation cycles, although there's pandemic, it's probably not the same as previous market dislocations that we've had. And so I guess in this situation, from your viewpoint, where can one find the best risk-adjusted returns as a lender?
I think maybe just taking a step back, what is very different in this crisis from, say, the GFC is that the debt against real estate is much more widely dispersed. So the banks have been relatively cautious, both in terms of the LTVs and the types of assets and the clients that they will lend to, but also just the volume. So there's been a huge rise in private credit lending, as you will know, since really 2010, and that's increased. And so we just have a much more dispersed holding of real estate debt. And then secondly, I would say that generally, as a rule, the market has been much more cautious than it was up in the run-up to 2007, 2008. And so in many respects, the real estate debt market is in much better state than it was historically. And naturally, that would lead you to conclude that there's probably going to be less pressure on lenders to undertake some of the big disposals that they did last time, which then may suggest that there's going to be less distress available in the market. We've already seen banks take a very collaborative approach to this crisis with lenders. We ourselves have done exactly the same, and I know a lot of other debt funds have taken the same approach. And it's a much smarter approach than saying, well, there's been a crisis, we're going to throw our toys out of the pram, we're going to take the asset and we're going to dump it. There's not that push this time to do that, and I think that will probably restrict the amount of distressed opportunities. Where I do think there are opportunities is dislocation, and I do make a separation between the two. Distress, I think you have to either as a lender or an LP into a fund looking to take advantage of distress, you have to have some pretty specialist skills. And you have to really have a very open mind as to what you're going into, because distress by its very nature means there's some very fundamental problems in that marketplace. Dislocation, I think, is different. It is an arbitrage on liquidity constraints for irrational reasons. And I really do think that's where the opportunities lie, not just now, but over the next 12, 18 months. We've seen a lot of lenders pull out of the market, including the banks. The criteria have become even more restrictive, but that doesn't mean there aren't excellent lending opportunities out there on sound business plans across the capital structure, from senior to whole loans to mezzanine. The fundamentals of real estate lending, doing your diligence on the sponsor, understanding not just today's value, but a sort of a market cycle valuation, which is something we look a lot at. Your sustainability of income, your covenant packages, your security package, et cetera, all these fundamentals are still the key to making good loans. So in summary, I don't think there will be a huge amount of distress. Clearly, retail offers more opportunities, but it really is a redevelopment play, because I think, as Simon said, there's fundamentals there that means we do have too much retail. So we need to take that space and make it something different. You probably saw McCarthy and Stone talking about buying town centre retail for redevelopment into the more assisted living or older persons residential living. I think that is symptomatic of what will happen there. So that's a very opportunistic development-led strategy. You know, hotels, we're clearly going to see some what you might call distress, but I think in reality, they need capital to get them from where they are now, which is in a very bad position, to what the new status quo will be. We will still travel, we will still go and stay in hotels, but perhaps just a little bit less, and clearly they need to transition to that new model, and they will need injections of capital to do that. So there will be opportunities in that sector. And certainly from our perspective as a lender trying to outperform the market, we'll be selectively looking at that dislocation.
I see. So you've talked about dislocations within sectors. What about dislocation in regional markets? So, for example, UK versus Ireland versus Europe. What are your thoughts around that, and how do you play that to maximize your risk-adjusted returns for as a lender?
So I think there's dislocation with regards to the sector, as we discussed, geography, and also the size of loans. Maybe just taking geography, the UK is probably the most well-funded market outside of Germany. Most debt funds in the market are based here. They have a familiarity with the UK, but clearly the UK is facing its own sort of unique challenges with regards to not only the pandemic, but Brexit coming at the end of the year. So I think it will present opportunities, but I think the fact that it is so well banked will keep returns lower than you might expect. And I think that's particularly the case, I think Simon again pointed out, this polarization in the market. If you have a prime logistics asset, a prime PRS asset, there is liquidity right now for that. And there may be a 25, 50 bit premium to what it was pre-COVID, but that's still there. If you want to fund a shopping centre and you don't really have a redevelopment plan, that's incredibly difficult right now in the UK, but it would be anywhere. So there's this polarization in the marketplace. But UK generally, I'd say there's a lot of liquidity. Ireland is a strange market. When it's hot, there's a lot of money flows in, but there's not a lot of domestic capital. So we have found right now that there's a significant lack of liquidity for debt financing, and that presents a lot of opportunities from our perspective. The other place that we play in, or starting to play in, is the Netherlands, and I would say that's probably in the middle. If you have, again, a prime deal, German banks, Dutch banks are still very keen. And then you stratify by size, and I think historically what we found is, and this is why we focused on it, the sub 25 million market was incredibly attractive. There was you couldn't lever those transactions either individually or from a fund perspective, really. And so, whereas other people were writing £50 million loans at 4% because they got loan-on-loan finance, we were writing the same loan, essentially, at 20 million and getting 6% plus. And there was just an arbitrage because of how people were financing those deals. That clearly now is gone. There's very little loan-on-loan financing. It's very difficult to underwrite a deal on the basis of selling down an A note without creating a lot of execution risk. And so ultimately, I think there is still an arbitrage on size, but I think maybe that gap is narrowing and we are seeing spreads moving out across the band on anything that isn't vanilla. So what may have been 4.5% now could well be 6.5% to 7.5%. How long that window lasts will depend, I think, on the economy, will depend on future lockdowns, but there is a lot of money, as you said, pipe for real estate debt. There is a lot of money sitting there. There's a lot of dry powder ready to take advantage when there's a little bit more certainty on where we come out economically.
Interesting take there. Perhaps I'll shift over to you, Simon. And I think, you know, you obviously focus on equity investments, but at the same time, you may seek real estate finance to supplement or to top up on what you're doing on the equity side of things. Perhaps it would be quite interesting to share your thoughts as a borrower, telling off from what Gareth just mentioned.
Yeah, I mean, that's really interesting actually, because unfortunately we don't do many plain vanilla deals. We do a lot of kind of entrepreneurial repositioning, development, etc. And it's pretty straightforward to get debt for a straightforward income producing asset. Even now, as the guy said, the cost might be slightly higher, but the money's there. What we are seeing though, it's probably even more difficult to get debt for the things that are more entrepreneurial. So for some of the industrial developments we're doing at the moment, actually we probably have got debt on the table from either debt funds or one or two kind of state-backed specialist lenders. But there is almost no debt available from the clearing banks. The only clearing bank debt we have is on our more established portfolio. So again, that flex-based business, we've got about 50% loan to value, but that's got about 3 times interest cover just on income alone. So that's quite easy to fund. But as we go into this sort of COVID-related recession, what the banks aren't quite saying is that a lot of them are almost closed for business. They're very slow in getting any credit approval. And actually getting debt for a deal is becoming harder and harder. And even last year, actually in Brexit, we did one refinancing that was very simple. It took 6 months from start to finish to refinance one deal with the same incumbent bank. We're finding KYC a lot harder, just the administration of loans, getting through credit. The whole account opening process is increasingly painful. And actually, we're, if anything, probably borrowing a bit more from some of the debt funds. So in our Birchgrove business, which again is assisted living, where we're developing the assets from scratch, we're actually borrowing from debt funds at, say, a typical all-in rate of maybe around 7%, which is just about okay. What we can't do is borrow from mainstream banks at kind of 3 or 4% all in. Very, very difficult. So I couldn't tell you what our borrowing ratio is at the moment, but it's probably only 30–40%, and we'd probably like to be closer to 50. But for some deals, we just can't get debt at all.
So Gareth, it seems like there's a huge pipeline coming your way potentially.
Let's hope so. Yeah.